Hello, friends. How are you all doing? Hope you all are doing great. So, welcome to question 51. And this question is about accusation and merger. So, this is a 50-mark question on accusation and merger. Since I told you that accusation and merger net present value is most expected in 50 marks question. Now, net present value. So, what are the areas we have covered for 50 marks so far? 48 and 49 focused on reconstruction or reorganization. 50 was on net present value, which was investment appraisal. And now coming to 51, this is your acquisition and merger. Okay. And we also have some theory part in it. Of course, every 50 marks will have theory. And you'll be giving more marks for the theory part in your section A, which is related to the main topic. Like in this case, it is acquisition and merger. So your theory part will be from acquisition and merger. So coming to part A, there are three requirements, A, B, and C. C is your report, A and B is your theory part. So coming to A, discuss whether or not Nahara Company accusation strategies of pursuing risk diversification and of purchasing undervalued companies can be valid. So you have to say whether it is valid or not. The accusation strategy of this company, okay, you don't have to read the case study. By looking at the requirement, you can tell that the accusation strategy of this company Nahara is to either for the risk diversification, they are acquiring company maybe to diversify the risk, or they are purchasing undervalued companies. Why is it? Can it be valid? Risk diversification and undervalued companies, can it be valid? To answer this, you have to know some theory part of what is this risk diversification and what is this undervalued companies. When you value and when you acquire this, how and all it impacts. So this you have to know, and it is for 7 marks. Okay, and the marks is divided equally between these two components. We'll be going through this, don't worry. Coming to part B, discuss why the European Union may be concerned about the company's stated intention of intention and how selling the company could reduce this concern. So this is also about European Union. Why they will be concerned when Nahara makes a statement that they want to sell this company. Fugai. So Fugai is a company which is Nahara has acquired, okay, and now they want to sell it. But this Fugai company is in the zone of European Union. So now you have to discuss why European Union will be concerned. So this type of question, part A, part A question is more like a general type of, it's like a theory. This explanation is there in your textbook. But when you're coming to part B, this explanation is not there. This is specific to this case study. You need even that's 4 marks, but what are those 4 marks? You need a little thinking in that. Coming to part C, your main part, report. For whom? For the board of directors of Avem company. If you see there are so many companies they are listing here, you will understand all who all are there. But let's see, there are 3. Now, since you have seen, if you haven't, it's okay. But if you have seen my video from 48 till now, the way they asked a question for report, the structure and all, you should be very familiar by now. It is repeated only. Assumptions will be there, all those things. Okay. So prepare the additional value created for Avem company if it acquires for Fugai without considering the luxury transport project. So there is some luxury transport project going on. Without that project, you have to estimate the additional value. Basically, additional value of accusation. Additional value for this without this. Okay. 10 marks. So your report also has to be in that way. Coming to second part. If you see a 25 marks question with a 50 marks question, you can see the difference how a 25 marks question, like in the same topic, accusation and merger only, you will see the difference how it is asked. More or less, it is same only the way it is asked, but the marks will be more here in 50 marks question, and also it is a report format of course, and 25 marks question it is not a report format. And also you will be getting you have to talk more points, like you have to be ready with your assumptions and all. Maybe in part section B you don't have to always, assumption is not required. It's more on calculation, and maybe very few marks for theory. But coming to section A, 50 marks, you cannot say that theory is just 5 marks. No, maybe a 20 marks is for theory, you can't say. So if you see this, 7 and 4 makes 11 marks, and 11 is just separate theory, but even in this report you have to write, not just calculation part. Now coming to the second part of the report, estimate the additional value of the luxury transport project to Fugai both with and without the offer from Lumi company. So if you see this question looks a bit complicated because so many companies are involved, Avem or Fugai, then Nahara, then Lumi company. Who are all this? You will not know, but still start with the requirement first. Okay. So estimate the additional value to this both with and without the this. And coming to last part. Okay. See, assumptions will be there in your report. You cannot skip that assumption part. Whether it is for acquisition and merger, whether it is for reconstruction, whether it is for investment appraisal, whether it is for exchange rate risk management, whether it is for role of senior financial advisor, whatever the 5 syllabus area. Of course, it comes from the other 4 syllabus area, not from the first one. First one is theory part. So whatever area 50 marks come, assumption you have to be ready. Let's say your exchange rate risk also, we'll see a question on that also, how an exchange rate risk can come for a 50 marks. So far we didn't attempt one, but I'm expecting that maybe later we'll have. So evaluate the benefit which is attributable to Avem and Fugai for combining the two companies with and without the project. So benefit of to this and this of combining with and without the project, and conclude whether or not the accusation is beneficial. You have to conclude whether this accusation is beneficial or not. The evaluation should include any assumptions made. Even though they say or they don't tell you, you have to state your assumptions. Mostly they will be telling you only. Okay, and rest all 4 marks. Please put time beside the marks, how many time you require. I have told you 1.8 minutes per mark. So let's say this is the first one is 7, it will be 7 into 1.8. Likewise for the others also. Now coming to the case study. Okay. So Nahara and Pugai. Nahara is a private holding company owned by the government of a wealthy oil-rich country. Okay, to invest in sovereign funds. Nahara has followed a strategy of risk diversification for a number of years by acquiring companies from around the world in very different sectors. One of the Nahara's acquisition strategies is to identify and purchase undervalued companies in the airline industry in Europe. A recent acquisition was Fugai, a company based in country which is a part of European Union. Now you see Fugai is a company which is based in Europe, and that's why they are concerned when Fugai is about to be sold to another company. So Fugai, what does they do? They repair and maintain aircraft engine. A few weeks ago, Nahara stated its intention to pursue the acquisition of an airline company based in the same country as Fugai. The EU, concerned about this, asked Nahara to sell Fugai before pursuing any further accusation in the airline industry. So the EU is saying to Nahara, already Naha has acquired Fuguai company. Before they acquire another company, they have to sell Fuguai. Okay. So now for our part A for 7 marks, you don't need to read the other parts. First part itself is enough for you. We don't have any points here. Okay. Because our first part A is theory part. Risk diversification undervalued companies, you have to talk about that, where you don't require any calculation or all. So I'm not reading further. From here itself, I'm going to write the answer. Okay. If you want, you can read the whole case study and then answer part A, B, C, or you can now itself you can answer. I would suggest, if I was you, I would read only the relevant part, because since I've been doing many question practice, you will be of course when you go to the exam hall, you must have done many practice. You know by looking at the paper which one is relevant. You know that the next one will be relevant to you or not. You're not reading the whole thing, of course, but you can skim, right? Skim through and see, because the rest all talks about other stuff. It does not talk about risk diversification or undervalued companies. usually you will see a pattern that the way A, B, C, okay, your requirements are stated, even your paragraph, let's say requirement A is the first requirement, right? So if that first requirement will come in the first half only of your case, and the second requirement will be from somewhere second, and the third will be last somewhere from the last. Usually it follows that method, not 100 time, not 100%, but most of the time it follows this order only. For the theory part you can use, but for calculation, yes, throughout the case study you have to use numbers, because you have to pick some theory parts also to the calculation part. So coming to the part C, now we can answer part A. uh, we'll see how it is. Okay, so like individuals holding well diversified portfolios, a company could reduce its exposure to unsystematic risk by creating a number of subsidiaries in different sectors, right? That's the meaning is, if companies having different subsidiaries, okay, in different sectors, then they can reduce their exposure unsystematic risk too, like how individuals are holding well diversified portfolios. So they are linking the individual with the company. Why they are linking this? Because you want to prove that point, diversification of risk. That's why you're bringing this point. Coming to the next, this may lead to a reduction in the volatility of the cash flows. What happens because of that diversification? Reduction in your cash flow is more stable. That volatility of cash flow reduces, which may lead to a better credit rating and a lower cost of capital. When something reduces, what is the impact you have to tell? Okay, volatility means cash flow becomes more stable. When cash flow becomes more stable, your credit rating improves and cost of capital reduces. The argument against this states that since the individual shareholders can do this themselves both quickly and cheaply, there is little reason for companies to do this. Okay, so the one reason could be that diversification of risk. They want to acquire risks because see, individual shareholders, they can do this very easily, very cheaply compared to the companies. Okay, for companies there is very little reason for them to do it for the diversification of risk. Okay, whenever diversification of risk comes, don't forget to talk about the unsystematic risk, how when individual holds and how company is going to reduce this, you have to tell. Next is how this is having an impact on the cash flow. Then credit rating will improve. Then cost of capital will reduce. That's why it's in bold. That means this things has to be there in your answer. That's why it is in bold. Then they're also saying individual shareholders can do this, but companies have very little reason to do. Indeed, research suggests that markets do not reward this risk diversification because diversified portfolios are often managed inefficiently because head office struggles to cope with the different issues facing each subsidiary. It is very hard for the head office to control or to manage all the subsidiaries very efficiently. Therefore, that risk of diversification is not going to have any benefit in this case of acquiring subsidiaries and subsidiaries. Okay, different subsidiaries in different sector will not help in this diversification process in a company level. Okay, that's what they are saying. Often it is not rewarded. As a result, decision making may be ineffective and slow. It is in bold. That means keywords. Just emphasizing on the keywords. So I don't have to underline anything. Coming to the company, now you have to link with this company. For Nahara, undertaking mergers and acquisitions may have beneficial outcomes if the sovereign fund has its entire investment in the holding company and is not well diversified itself. Okay, let's say all the fund is there in Nahara company only, the holding company, and it is not well diversified itself, then yes, you can tell that having acquisition and merger in different sector, subsidiaries in different sector will be beneficial. That in that case unsystematic risk can be reduced, then it will be beneficial. That's what they told in the next line. Again, bring unsystematic risk. You have to link this risk, by the way. Whenever diversification of risk comes, unsystematic risk automatically comes into the picture. So in such a situation, unsystematic risk reduction can be beneficial. The case study does not state whether or not this is the case, and therefore a definitive conclusion cannot be reached. Whenever you cannot reach a conclusion, mind you, you have the freedom of saying that this nothing has been mentioned in the case study, so you cannot take a stand, or a conclusion cannot be reached. You can tell that. You are very free to tell that also. It is not every time that you have to get an answer, yes or no. Sometimes there is no answer because nothing has been mentioned in the case. Coming to the next, if Nahara is able to identify undervalued companies, So now they are coming to the undervalued part. That systematic part is over. Now they are focusing on the undervalued. They want to purchase undervalued company because you have to prove the point whether it is valid or not. If so, what conclusion did you reach for the diversification of risk? Nothing. You told no conclusion cannot be reached. But now let's go to the undervalued companies. If Nahara is able to identify undervalued companies and after purchasing company can increase the value for the holding company as well by increasing the value of the undervalued company, then such activity would benefit their shareholders. However, for this strategy to work, Nahara must. If Nahara, okay, now can increase the value of that company after purchasing, the value of what company? Undervalued company as well as the holding company, then yes, we can tell that acquiring an undervalued company is beneficial. But for that to happen, for them to increase the value on Nahara has to do these things. Okay, it is mentioned in different bullet points. You can see the first one: possess a superior capability or knowledge in identifying bargain buys ahead of its competitor companies. Of course, whenever a new more something comes up in the market, or something comes where you have more information about, or you know that it is going on bargain, where you can bargain, where your friends or your colleagues does not know much about it, you will be the first one to go there and get it before anyone comes to know, before your friends or colleagues comes to know about it. You'll be the first one to go and buy it. You'll be bargaining and you will get it, something which you can get at a low cost. You know, you can bargain and get it at a low cost, undervalued. So same way for the company also, you should have that knowledge, superior capability or knowledge that no one knows. So to achieve this, okay, it must have access to better information. Of course, you should have access to better information which it can tap into quicker or have superior analytical tools. This implies that the stock market is less than semi-strong form efficient. If the stock market is accurately valuing companies using all available public information, then share price are unlikely to be undervalued. Mark this word, semi-strong form efficient. What is the semi-strong form efficient? We study three type of this thing. One is weak form efficient, the other one is strong form efficient, the other one is semi-strong form efficient. We studied this where? This is taught even in financial management. This is not taught in advanced financial management, the theory behind this, but an AFM student is supposed to know this because this is from F9, FM, financial management. And for AFM, you are required to have the knowledge of your F9. You cannot come and tell that I forgot, or in AFM we are not taught this. No, you have been taught this in your F9. So you should know what is semi-strong form efficient. If you don't, you can Google and check. Right? I'm not going to explain this right now. Otherwise, this video will, go up to 3 hours. Okay, so now going to the next. Ensure that it has quick access to the necessary funds. Yes, necessary fund is required to pursue undervalued accusation. Even if Nahara possesses superior knowledge, it is unlikely that this will last for a long time before its competitors find out. Therefore, it needs to have the funds ready to move quickly. See, when a company is undervalued, it does not stay undervalued for a long period of time. It will increase in price. So before anyone knows about it, or your competitor reacts to it, or they try to get it, you should make sure that you have the necessary fund with you so that you can take quick actions. Just having that knowledge or information is not enough. You should have funds to act on that quicker than your competitor, because it's not a long lasting advantage, that knowledge or something, given that it has access to sovereign funds from a wealthy source. Okay, access to fund is probably not a problem. This line is given in the first line, if you see. Okay, it is in a private holding company owned by government of a wealthy oil rich country to invest in sovereign funds. So you can see, so the by looking at it, the fund won't be a problem. Coming to the third, ensure it has competences in turning around underperforming companies. You should have a competence, Dahara, of turning the underperforming companies. This will require a measure of understanding of the sector. Yes, you should have an understanding of the sector that the acquired company is operating in. It is likely that Nahara can develop expertise in a wide range of sector, but not in all sector. Yes, possible. All most of the sector you can have a expertise, but not all the sector, each and every sector. So there will be a limit to the validity of a limit. It is in bold. Limit to the validity of a diversification strategy. Yes, you cannot say it's not valid or it is valid, right? If you cannot say it properly, then this is the way of saying. Ultimately, something you have to say because you have to say whether it's valid or not. So they are saying it limits to the validity of a diversification strategy. Okay, so part A is over. 7 marks. We'll see how the 7 marks is awarded. So 2 to 3 marks for risk diversification, because risk diversification you don't have much things also to talk about. We usually get points where we can have more points to talk about. So purchasing undervalued companies is, if you see, it is 4 to 5 marks. That means something you should know about undervalued companies and all. What are the points you have to know? Just now the points we have discussed. Coming to part B, if you see, it is for 4 marks, 1 to 2 marks per point. So coming to B, what was B? Why the European Union will be concerned. Okay, so now we'll read it. In a similar manner, okay, to the Competition of Market Authority in UK. So you are linking this with this. I hope you didn't forget this. You know it, right? What is the function of it? The EU will assess significant merger M&As, mergers and acquisition impact in terms of whether they will lead to a substantial lessening of competition within a country's market. Yes. Job of an EU is also, the role of an EU is also to see whether significant mergers and acquisition will reduce the competition in the market or not. It, for example, used tests such as worldwide revenue and European revenue of the group after the mergers and acquisition. It may block mergers and acquisition if it feels that mergers and acquisition will give the company monopolistic power or enable it to carve out a dominant position in the market so as to negatively affect consumer choice and prices. This is more like, if you see, roles very similar to competition and market authority only. Even the competition market authority does the same thing to protect consumer. They are trying to see whether competition is not reducing. They want to increase competition, not reduce it. They don't want monopoly. They don't want a company to hold monopolistic power by combining and becoming bigger and bigger and to exploit customer. No, their job is to protect customer. Their job is for the not a significant mergers and acquisition, not to support where it can lead to a monopolistic power. Same role is for the EU also. So the same thing you have to talk. Okay, sometimes the EU may ask for the company to sell some of its assets to reduce its dominant position rather than not to allow. So, okay, they can let mergers and acquisition to happen, but before that, you have to sell some of the asset. That is one of the thing you can do to reduce the dominant position of that company before mergers and acquisition. It would appear that this may be the case behind the EU's concern and the reason for its suggested action. Yes, maybe this other way. So just giving this point is not enough. You must have ended here. But this line has to be there. Why you discussed about it? Because this is the requirement. Why they are concerned. So this might be some of the reasons why they are concerned. Coming to part C report. This was the format I gave you. Okay. To whom? Board of Directors of Avem company. Clearly they have mentioned. From whom? AN consultant. You are a consultant. Subject. Any subject you can give. Proposed accusation of this company and date. The date of your exam you have to give. Introduction. Introduction is very small. Okay. Introduction is basically all your requirement. Okay, so this report considers whether Avem should acquire Fujia in order to assess the additional value created from bringing the two companies together. The value of the two companies is determined separately and then as a combined entity. So you're telling them how you got that additional value. How do we get the additional value in acquisition and merger? We first find the value of the two companies separately. Okay, and then from the combined companies value, we deduct the two companies separate value and then we find the additional value. The report concludes by considering whether or not the acquisition will be beneficial to Avem and Nahara. So you have to tell the report will conclude on one note. Very small, very brief, the introduction, 4 lines coming to this. Set in order only, I told you. So additional value created for Avem without considering the luxury transport project. And additional value created for Avem including the luxury. So this is without, this is including the luxury. If you see each working is done in appendix, no working is done here. You can see some numbers. Those numbers are from your appendix. So this part of your report you cannot write now. You have to first go and do your appendix and then come back and fill the report. So write your subheadings and keep space. Okay. Make a judgment how much of space you might need. Then coming to your assumptions. Okay. So about assumptions will not come now. Okay. One good thing about assumption is assumptions you can fill it. You don't need your calculation to write assumption. Assumptions you can write. Start writing now also. But we'll do at the end. Okay. And then your concluding comments. Conclusion, if you see, it is just 4 lines. So introduction 4 lines, conclusion 4 lines. Now coming to appendix. Appendices. Appendix 1. Additional value created from combining Avem and Fugoi. I'm sorry. So this additional value when you have to create, okay, combining this and this. What is your starting point? Your starting point should never be what is the combined company's value. Your starting point should be the individual company's valuation first. First calculate the two companies company value first, their value, then find the combined value. Why? There's a reason why. Because you need that figure to find the combined company's value later. That's why combined company's value you have to do later at the end. First it is individual company. Which company? Avem or Fugoi? Any company you can do, does not matter. So here in this case we didn't read the case study, so let's go back and read the case study. I just wanted to bring you till here so that you know. Now first part we have read. Now coming to this part. So Avem company's acquisition interest in Fugoi. So Avem is the one who's acquiring Fugoi. Okay. Avem is a UK-based company specializing in producing and servicing business jets. Has approached Nahara with a proposal to acquire. So Fugoi has been acquired by Nahara before. Now Nahara has to sell it to Avem. Now Avem is the one who is buying Fugoi. In other words, for this much. Okay. Nahara expects to receive a premium. Now, understand who is selling, who is the one who is receiving. Okay, here Avem is the one who is buying, so Avem has to pay. Okay, to whom? Nahara. Because Fugoi has been acquired by Nahara, it is in the hands of Nahara now. Nahara is selling it, the Fugoi company, to Avem. So Nahara is the one who will be receiving the premium from Avem company. So Nahara expects to receive a premium of at least 30% on the estimated equity value of Fugoi if it is sold. Given below extracts of Avem and Fugoi, you can see share capital reserves, non-current, current liabilities. Each Avem company share is currently trading at 7.5, which is a multiple of 7.2 of its free cash flow to equity. Free cash flow to equity. Write it somewhere. Avem expects that the total free cash flow to equity of the combined company will increase by 40 million due to synergy benefits. Okay. So what is the synergy? It's 40 million. After adding the synergy benefits of 40 million, Avem then expects the multiple of the total free cash flow of the combined company to increase to 7.5. So after adding 40 million, this is the synergy after. Very important. That after word is very important here, because sometimes it is very possible that without adding that 40 million itself, you are taking it as 7.5. So Avem's multiple of total free cash flow of the combined company to increase to 7.5, not by 7.5. Always check in front of increase or decrease whether it is to or by. Makes a lot of difference. To 7.5 means it is 7.5 only, multiple. Means PE ratio. Okay. Now, Fugai's free cash flow to equity is currently estimated at 76.5. And it is expected to generate a return on equity. Return on equity, cost of equity. Okay. Over the past few years, Fugai has returned 77.3% of his annual free cash flow to equity back to Nahara while retaining the balance for the new investment. 77% they have returned. That means why this figure is given to you, we'll find out later. Okay, who has returned Fugai? Fugai's company's non-current liabilities entire. Okay, let's go to Fugai. If you see, it has one non-current liabilities of 380. I can see here. It is 380 here, this one. Okay, it includes $100 nominal value bonds which are redeemable in 4 years at a nominal value. Redeemable in 4 years, on which the company pays a coupon. So coupon is 5.4%. The debt is rated at B plus. Okay, and the credit spread on B plus rated debt is 80 basis point above the risk-free rate. Okay. Why this is given to you is for you to find what? Cost of debt. Now coming to the proposed luxury transport investment project by this. Now, we don't need this at this part of our this thing. This part also we'll read later. Okay, since we know clearly that we have to find without it, so first we'll find without and then later we'll move with, so that you don't become so panic. Okay, because reading too much of information also it becomes very which one to take, which one to leave. It's like that. So I don't want to create confusion for you, so we'll not read that part now. We'll directly go to part B. Okay, everything is done, the report, everything. So now if you see you have to go to appendix. So first we are going to start with Avem. Avem is the one who's going to acquire. Okay, so Avem's current value, it is 7.5 into 1,600, 12,000. How 1,600? Well, how 7.5? It is given there. Okay. If you see here, Avem is currently trading at 7.5, and here it is 850 cents per share. So it is 800 divided by 50, which is 1,600, and then each is for 7.5. That's how you're getting 12,000. But when you're coming to the Fugai company, okay, it has a lot of working. It is not clear like Avem. To estimate Fugai's current value, we need to estimate a growth rate. This is calculated on the basis of the BRE model. Which model we used? Refer that model. And what is the formula? B. What is BRE? That means B into RE. RE is your cost of equity. Your cost of equity has been given at 11%. That is your return. Rate of return. Okay. And they told that 77.3% you are returning it back. And the rest you are returning it to invest later. So that retention, R is the retention rate, how much you are retaining. So 1 minus of how much you are distributing. So 1 minus 77.3%. This is wrong, by the way. Okay, just check. It is a printing mistake, error. Error is the actual amount is this only. I have checked it by myself. That time I got. I was I was thinking also why that difference. It is not 0.267. It is 0.227. That's why every time you don't have to refer the answer, you have to do calculation in your calculator and check are you getting those figures or not. Just don't totally rely on those figures. So it is this is the growth B into RE. So this is B, RE is 11% and this is your growth rate. You need your growth rate. Your free cash flow to equity for Fugai has been given at this. Increase this by the growth rate, and since this is free cash flow to equity, you are not using back cost of equity, only are using 11% minus the growth. So this is your value of Fugai. You have got the value of the two companies separately now. So the value of the two company before the combination is approximately the addition of this two company. Now coming to the combined company. The combined company is expected to have a value that is 7.5 times its free cash flow. Avem's free cash flow to equity. We don't know what is Avem's free cash flow to equity. We have been given the price earning ratio, okay, and the value of Avem's. How are we getting that? We have been told. Here's something. In the first line, which is a okay. Each FM is currently trading at this one, which is a multiple of 7.2 of its free cash flow to equity. 7.2 of its free cash flow to equity. So that means what are they trying to say is the value of the company is equal to value of Avem. Avem is multiple of 7.2 of its free cash flow to equity. That means 7.2 multiplied by what? Free cash flow to equity. What is our job? To find free cash flow equity. So what should we do? Value we have found, value divided by 7.2. We are getting free cash flow to equity. Simple. So first, to find the combined company, first we have to find the Avem company's free cash flow to equity. That's why I told you don't start with combined company. So value we have just now calculated, divided by 7.2 to get the free cash flow to equity. Because we have found for Fugai, so we need for both the company free cash flow. So the combined company is expected to have a value that is 7.55 times its free cash flow. That means that multiply by 7.5. So Avem's free cash flow to equity is 12 million. This is this value. Okay, value of whom? 12 million. It is only the value of Avem company. Divide by 7.2. You are getting free cash flow to equity. Now, Fuga's free cash flow is 76.5. Okay, and this, that was their free cash flow to equity. And it is expected to increase by the expected synergy of 40 million. So we can estimate. Okay. By the way, we are not taking this. Okay. We are not taking this value. No. This is the current for this. Okay. We have to take free cash flow to equity only. That is the total value. That is the value of the company. We don't want value of the company. We want free cash flow to equity to multiply it by the multiple, the price earning ratio. That's why we are only taking the free cash flow to equity of both the company. That's why 76.5 million. And it is expected to increase by the expected synergy. So this we have to first increase. They told after adding synergy only. Okay. So we can estimate the additional value created by the combined company as value as a combined company minus value of Avem and Fuga as independent companies. That is the additional value. Okay. This one. What is this? Free cash flow to equity of Avem. This one. What is it? Free cash flow to Fugai. This 76.5. What is this 40? Synergy. Add all, then you multiply by 7.5. Because times free cash flow, that will be your value. That minus this value. Which value? Value of Avem and Fugai separately. We just took, where is this one? Minus it. So this is additional value. Your combined value should be more than the addition of the two companies' valuation. So this is the addition value. You have to tell how much it will go to Avem and Nahara because the question asked you. So Nahara, how much they will expect? 30% return. They want 30% premium on the value. So the gain to Nahara for selling this is 30% on this value. Not 451.5. No. for selling Fugai. What is the value of Fugai? Go up. I have underlined and I put cross also 922.5. So on that they are having 30% for this. Therefore, Avem will gain how much? This is a wrong figure again. Typing error. It is 100 and it is 17 point. Wait, something is. Yeah, it is 174.7. Yes, yes, it is correct. Somewhere else it was put as wrong figure. Here it is correct. It is 174.7 only. I'm sorry, but this amount has been put as a wrong figure and somewhere else later. So therefore, FM will gain how much? That additional value is how much minus how much it goes to Nahara. The remaining goes to FM. Now coming to Appendix 2. Okay. Let me just check. So Appendix 2 goes for your second requirement. So that is including the luxury project. So Appendix 2 I'm not going to explain now. We'll just fill this report. We are writing this part without the luxury. We have done the calculation. So now what you have to write? Appendix 1 shows the additional value created from combining the two companies. It is approximately this. And out of this, this much went to whom? Nahara, which represents a premium of up 30%, which is the minimum acceptable to Nahara. The balance of the additional value will go to Avem, which is about how much? This 174.7. This represents an increase in value of this much, okay? 12,000 because the value of Avem is 12,000. So out of that total value, the value additional value went to Avem is 174.7, and which is 1.46% only. Okay. So increase in value is 1.46%. So if you see in the report, what you are writing is just the main figure and little explanation. That's it. What is the value of combined company? How much is going to Nahara? How much is going to Avem? And what is the percentage? That's it. Coming to second, additional value after including the luxury project. This you have to do Appendix 2. For this, we need to read the other part in our case study. Otherwise, you will not be able to do it. The proposed luxury transport investment project by Fugai. So in recent years, the country in which Fugai is based has been expanding its tourism industry and hopes that this industry will grow significantly in the near future. At present, tourists normally travel using public transport and taxis, but there is a growing market for luxury travel. If the tourist industry does expand, then the demand for luxury travel is expected to grow rapidly. Fugai is considering entering this market through a 4-year project. The project will cease after 4 years because of increasing competition. The initial cost of project is expected to be Initial cost is this 42 million and is expected to generate the following after-tax cash flows over its 4-year life. So this is the after-tax cash flows. The above figures are based on the tourism industry expanding as expected. However, it is estimated that there's a 25% probability. This is a little tricky area, by the way, this part. Okay, when you see the calculation, you will understand. Because it is hard actually what to do with this number. Hard thing is that not how to do, what to do with it. You know it is there, but what to do. So whenever a probability and a net present value is given, it is giving a hint that you have to find expected value. That is what is required. That's why the probability is given. Because with probability and net present value, you can find expected value only. So here also we can see some probability. Above figures are based on tourism expense. Okay. Expected. However, it is estimated that there's a 25% probability that the tourism industry will not grow as expected in the first year. If this happens, then the present value of the project cash flows will be 50%. Present value will be 50% of the original estimate over its 4-year life. That means whatever the present value you have got over the 4 years, out of that only 50% will be there if it is does not happen as prediction. This, and the probability is also given 25%. It is also estimated that if the tourism industry grows as expected in the first year, there is a 20% probability that the expected growth will slow down in the second and the subsequent years. And the present value of the project's cash flow would then be 0, 40% of the original estimates in each of these years. Okay, and the present value of the project will be 40% of the original. Coming to Lumi. What is this Lumi? Lumi is a leisure travel company has offered 50 million to buy the project from Fugai at the start of the second year. Okay, so Lumi is a different company who wants to buy Fugai, and forget about that Avem who wants to buy Fugai and all. Forget about that company at all. This is a new company now. He wants to buy Fugai. At what cost? At this cost. They want to offer this. Okay, Lumi to buy Fugai at the start of the second year. This is very important. When they are buying is very important. When a company is bought, which year is very important, because that discount factor you have to use. Correct discount factor is important. Fugai is considering whether having this choice would add to the value of the project. Okay. If Fugai is bought by Avem after the project has begun, that means after this project has begun, then it is bought by Avem, it is thought that the project will not result in any additional synergy benefits and will not generate any additional value for the combined company above any value the project is already generated for Fugai. So you don't have to worry about the synergy and anything at all. Okay. Although there is no beta. Now beta and all has been given to you, means you have to find cost of equity or cost of capital. One of those two things you have to find here. That's why that beta, whenever beta is there, they talk about beta means that only. Either cost of capital, either cost of equity. Although there's no beta for the companies offering luxury forms of travel in the tourist industry, Reka company, a listed company, offers passenger transportation services on coaches, trains, and luxury vehicles. About 15% of the business. You have to be very careful. This beta is not very easy. Two line of businesses there. About you have to spread it out. Take out the luxury part. 15% is in luxury transport market, and Reka's equity beta is 1.6. Reka company's equity beta is 1.6. It is estimated that asset beta of the non-luxury. Asset beta of non-luxury is given to you, not luxury. You have to find the asset beta of luxury. Is this. Reka's shares are currently trading at 4.5 per share. Shares are trading 4.5 per share, and his debt is currently trading at 105. Okay. This is Reka. First you have to take for Reka, use his capital structure, find the asset beta, then you have to adjust it for your company and find the asset beta, and then equity beta, and then of course cost of equity. It has 80 million shares in issue. Who has 80 million shares? Reka. And the value of the book debt is this. The debt beta is estimated to be 0. It is, yes, it is always 0. We assume it is 0 only. General information. Corporation tax applicable to all companies 20. So tax is 20%, risk free is 4%, market risk premium is 6%. Okay. Now coming to Appendix 2. If you see Appendix 2 value of the project to this one, it is project 2.1. 2.1 project cost of capital. So you're finding cost of capital. That means you need equity beta, unit asset beta, unit cost of equity, unit cost of debt. Everything is market value of equity, market value of debt. Everything is required here. It's a long, if you see, long calculation. Just say such a long calculation just to find what? Project cost of equity, capital. Okay, so estimate of risk adjusted cost of capital to be used to discount the project's cash flow. The project value is calculated based on its cash flow, which are discounted at the project risk adjusted cost of capital to reflect the business risk of the project to determine the beta of the company. project, we first need to calculate Rekha company's asset beta. Number one thing is Rekha company's asset beta. How are you going to find Rekha company's asset beta? First, find what is their equity value. Basically, you're finding the market value of equity for Rekha and for debt. So, what is the market value of equity for debt? 4.5 into 80 million shares, 360 equity, and debt 1.05 and 340. Okay. Then, what is the asset beta? Equity beta has been given to you of the Rekha. So, it is equity beta into the value of equity over value of equity plus value of debt into 0.8 because tax is 20%. So, after tax. So, this is asset beta. Okay. Just check it is this and this you have to check. It is less than equity beta. Correct. Technically, it is correct. Now, we can calculate the project's asset beta. Okay. How are we taking the project's asset beta? The 0.89, it is the total asset beta. Total. It includes both luxury and non-luxury. So 0.89 equal to project's asset beta into 0.15. Why? 15% is for the luxury part. That means the remaining 85% is for the non-luxury part. 85%. But for that luxury part, we have been given the asset beta. What is it? 0.8. We have been given the asset beta for the non-luxury part. So the balance is the luxury part. The project's asset beta is for the luxury part, which we have to find, which is 1.4. 1.4. Even this 1.4 has to be less than this 1.6. Just check. Because equity beta in any condition has to be more than asset beta only. Whether this or that. Okay. Now, before we can calculate, this lines has to be there. This statement in your working, you have to write why you have included something and why not something. So before we can calculate the cost of equity for this project, we will need to adjust it for Fujai's debt level. Fujai's debt level. Why only debt level? What about equity level? Yes, you have to adjust it for equity and debt both, but equity, we'll talk about it later. First, we'll work on the debt part. So what is Fugai's debt? 380 in terms of its book value. Why Fugai? Because we have to adjust with their capital structure. See, Fugai's debt and equity is different to compared to Rekha's equity and debt. That's why we have to adjust it. Right? First, we'll go to Fugai. How we got 380? It is from here. Just go to Fugai. It is 380. I have circled also. Non-current liabilities. That is only. That's it. That is the debt. Okay. So that 380 only you have to see. Remember, Fugai had a bond. That non-current liability. That 380. Okay. There's a bond. It's a bond. So you have to do bond calculation also here now. Becomes more complicated, right? To calculate the market value of this debt, we need to take into account the return required by debt holders. To calculate market value of debt, return is required. Return means was cost of debt. Cost of debt also you have to calculate. This can be estimated as cost of debt. What is cost of debt? Risk-free rate plus your credit spread. Risk-free rate is 4%. What is your B rated? It was a B rated, I remember. B rated or B minus, I think. The rate was 80 basis point. So add that. Over risk-free rate. Risk-free rate. Over risk-free rate means add with risk-free rate. 4.8%. This is your cost of debt. So now the current market value of 100 bond. You see how many steps is required. You have to find cost of debt. You have to find market value of debt. You have to find the market value of debt means the value of bond only basically. Okay. So current market value of bond. What was the coupon? 5.4%. And what is the cost of debt now? 4.8%. That's why you are using 4.8%. To the power minus 1, to the power minus 2, to the power minus 3, to the power minus 4 because 4 year. Redeemable in 4 years time. Coupon will be 5.4, 5.4. Last year when you're coming 100 plus 5.4, that's why 105.4. And this is the bond value per 100. Okay. 102.14 per 100 means 1.0214 only into 380. That is the debt, book value of debt. So this will be a market value of debt now. Coming to market value of equity. The market value of equity of Fuja has been previously estimated as this. Go up and check. Go up and check. You are a fool. If you're trying to calculate this again and wasting time, I'm sorry to say this, but it is true. If you're trying to find the market value of Fugai again and waste time, we have already done it. Okay, we'll go up and show. Okay, 922.5. That is the value. That is the equity value only. Why? Because this is free cash flow to equity. So no need to deduct your debt and anything from it. If it was free cash flow to firm, yes, in that case you have to deduct your debt from that, then only you can find for equity. In this case, nothing to do, as it is, because it is free cash flow to equity. That means for equity only. Now, so now we can take the asset beta of 1.4 and estimate the project's risk adjusted equity beta. So this 1.4 equity beta can be used to find the asset beta. Okay, what is it? Asset beta is equal to what? Value of equity over equity plus debt into 0.8 after tax into equity beta. So make equity beta the subject and it will be this. Of course, here this has to be greater than 1.4, but greater than asset beta. Just check all the time. Okay, that equity beta is only the greater one. Now use CAPM and find cost of equity. So risk premium is 6%. This is cost of equity, equity beta, and this is your risk free. So 15.2%. Now use WACC. Just see how for after everything they have given formula like this, like this, like this. How many formulas? 3 formulas. Make sure that you write the formula and then you do the calculation. So value of equity over value of equity plus debt into this. Here also same thing. Debt, equity plus debt, 4.8%. This was your cost of debt. You calculated and into after tax. So it is 12%. WACC. And there is a way of checking WACC, whether it is technically correct or not. Just compare this with this. Cost of equity will be more than WACC. Why? Because we have debt also in WACC of 4.8%. That's why your WACC will be less than your cost of equity. Now, why we need that? Why we did all this long calculation to get cost of capital to discount our project? We need a discounting factor. So of course, when your cost of capital working has to be number 1 and your WACC, your present value and all has to be a number 2. So that order you should decide which calculation should I do first. Appendix 2.2. Okay, estimate of expected value of project without the offer. So if the first year is as expected, and if you go down and see if the first year is not as expected, under both you have to find out because probabilities are different. We'll see if it is first year as expected. It is in $1,000. Dropping down the 3 zeros. Coming to the cash flow. Cash flow is given in your case study. Just write as it is. For the first year, discount factor 12%. Just now we have calculated above. And the present value. Once you find the present value, write the probability. What was the probability? If the first year it is as expected, because this is not your normal net present value calculation. Okay, you have been given probability means you have to find expected value. So if you go up and see, here we have been told it is also estimated that the tourism industry grows as expected in the first year. There is 20% probability that expected growth will slow down in the second and subsequent years. It will slow down by 20%. That means after that slowdown 20%, that means they will be now having 80%. And the present value will be how much? 40% of the original estimate. That's why if I go here, look at the present value. 1, no impact in the first year. From 2 year onwards, it will be 80, 80, 80 because by 20% it will reduce. So after reduction, so the probability. So what is your expected value? Present value multiply by probability. That is your expected value. So multiply it. And that's why it's in bold. Okay. So expected value. Now, present value will fall down by, will be 40% of what? Present value will be 40% of the original amount. So what is the original amount? The original amount is this only. this present values. Let me circle it for you. So on this you have to take 40%. That will be the present value. This only for the last 3 years. So 2, 3 and 4, first year no impact, so it will remain the same only. If you see this and this is same. So the problem comes in 2, 3 and 4. So 40% you are taking, 40% is this. Okay. On that, multiply by 20% probability again. Okay. On that you have to multiply by 20% again. By the probability. So the expected value is this. Basically you multiply this. If you see, this will be something else. This figure will come something else. The answer it's different. It will come as 1028.7. Okay. The rest all is same. And then total expected value. What is the total expected value? It is this. Okay. After you multiply by 0.2, 1029.3, basically this and this, you add. This 1 and 2, you add. It's 1 plus 2. The total expected value. Okay. Both expected value you add. So the total expected value from 1 to 4 is the first year as expected, is therefore you basically add all your total expected. This, add 4 and you will get this in thousands. Okay. There's a 75% chance of this occurrence. 25% it will not occur as expected in year 1. That means as expected in first year is 75% balance. So if the first year is not as expected, present value, okay, will we go there also? The above figures are based on tourism industry expansion. How it is estimated that there is a 25% probability tourism industry will not grow. So it will grow means 75%. As expected in the first year, this happens, then the present value of the British cash flow will be 50% of the original estimate. 50%. So what is the original estimate? Out of that 50%. So on that original estimate, you just have to take 50% as this. This is easier. Add all. This is the present value. This is 25% chance of occurrence. Now, what is the overall? Overall, it is in bold, so I'm not highlighting it. That means it should be there. Overall net present value of the project inflows, not net present value. We didn't deduct our cost. So 75% chance of occurring means what is the expected value? In the first scenario, from here, if it is expected 57087.7 and plus 25% into this, that it will not happen. Into the total expected value. So it is this. So the overall net present value is this minus 42 million. Okay. That is the cost. They will be required to pay this much. The initial cost is this much. So this is your net present value. This is without that offer from loan. Now, estimate of the expected value of the project with the offer from this. What is the expected value of the project? What is the expected value of the project? Let's go. Let's go up. See. Here. Loomis, a travel agent, has offered 50 million to buy the project at the start of the second year. Means at the end of the first year. So which discount? You have to discount this 50 million, by the way, by the first year discount factor. So what is the first year's discount factor? The first year's discount factor you will get from here. It is this 0.893. That's why you multiply this 50. You need to discount this 50 million. That's why I told you which year they are receiving it. Beginning of the second year means end of the first year. So 0.893. So that discount factor which you use, most of you might have taken the second year discount factor. That's what I'm telling you is very important. Wrong discount factor you can take, it is very common. So this. Now, if the tourism industry does not grow as expected in the first year, then it is more beneficial for budget to exercise the offer made by Lumi. Okay, because Lumi is paying this much, and this is the present value. Given that Lumi offer is this, if you see, okay, is greater than the present value of year 2 to 4 cash flow for that outcome. Why year 2 to 4 only? Why year 2 to 4 only? Present value you have to add. Why not year 1? Because on year 1 only you have to decide what will be your future cash flow. That means from after year 1 onwards, from 2 to 4. If that present value is greater than that 50 million, present value of 50 million, then only you will not accept. But here if you see from year 2 to 4, just check if it is not expected, if the first year is not as expected, into that condition only you have to see. Because in the first one, it is 57 something, right? Which is less than this 44 something. So you don't have to think about it. Here, second year, third year, fourth year, if you add, it will be less than 32 something, right? Which will be less than this 46. So that means we are having a higher present value from where? From here, from this Lumi's offer, not from this. So it is better to go for the Lumi's offer. Okay, to exercise the offer made by Lumi, because this is more beneficial, getting a higher present value compared to this year 2 to 4. This figure is then incorporated into the expected net present value calculation. So if the first year is not as expected, the present value of the inflows will become what? It is not as expected means what? You will take the offer from Lumi. So if you take the offer from Lumi, the present value is this much. With that, you add only the first year's net present inflow, this one. Okay, 1436. Because you'll be taking a decision after 1 year onwards only. So first year you will be getting it, the present value. Of course, if you are taking the project from Lumi, if you're accepting that offer, you're not getting that inflows from 2, 3, 4. But the first year, it is not dependent on that. That's why you are adding it with the amount you are going to get from Lumi. So that will be your total present inflow. If it is not as expected, make sure that you write it clearly. Then it will be this much. There's a 25% chance of this occurrence. So overall present value of the project inflows now it changes after Lumi. So 75% this remains same, no change. 25% only this changes now. From 32 something, before it was how much? 32,236.1, now it is 46,113.5. So it increased. So overall, so the project net present value, this will same, and this 42 million will remain same only. This will be this. Okay. Credit will be given for alternative solutions or calculations or recommendations. There are many ways of showing. So with calculation part we are over. Now we just have to put this in our report. Okay, now coming to Appendix 2. So we are refer the appendix. Shows that accepting the project would increase Fugai's value as expected net present value is positive. Yes, since it is positive, accepting the project will increase their value. After taking into account Lumi's offer. This is before Lumi, before, after. Just see how briefly you are writing in the report. But because all your calculations is in your appendix. When you're coming to the report, you're just writing sentences what's happening. Based on your calculations. So after taking into account Lumi's offer, the expected net present value is higher. Lumi's offer. Therefore, it would be beneficial, everything is in bold, for the company to take on the project and accept Lumi company's offer if the tourism industry does not grow as expected, and this will increase the company's value. Coming to assumptions. Only assumption is left now. Okay. Or assumptions and then your concluding comments. Before that, since we are towards the end and assumption is easy, just I want to take you through the what? Marking scheme. Very important again. Coming to part C, how you are getting marks. For the first, it is 10 marks. Avem's value, 1 mark. Avem's free cash flow to equity, 1 mark. Fugai's estimated growth rate, if you see, it is 2 marks. You need working to find that growth rate. And even their current value is 2 marks. Combined company value created is also 2 mark. Gain is just 1 mark, because no so much of working, wherever so much of steps is there, 2 to 3 marks you'll be getting for that calculation, but wherever it is easy, straightforward, just 1 mark. Coming to second part. Okay, Rekha's asset beta is 2 marks. Project asset beta is 1 mark. Fugai's market value of debt is 2 marks. You cannot ignore this. Valuation of bond, then the asset beta, then equity beta, then cost of equity, then WACC. So project equity, equity beta and cost of equity, 2 marks. Cost of capital, 1 mark. Annual present value of the project, 1 mark. Present value of different outcomes, 2 marks. What happens if it is accepted as first year? What if it is not? Expected net present value before the offer is 3 marks. Even after the offer is also 3 marks. Expected net present value means you multiply it with the probability. That is the only difference with the net present value and expected net present value. Present value of Nimni offer. What is the present value of that 50 million which they are offering? Basically 1 mark. For that itself is 1 mark. That's why you need that correct discounting factor. Coming to third. Benefits with and without the project, 2 to 3 marks. With and without the project, what are the benefit? You have to talk from both point of view. Benefit also and not disadvantages also. Assumption, 3 to 4 marks. Assumptions, oh my god, assumptions you cannot mess up. You need to know assumptions. Conclusion is just 1 to 2 marks. And rest all is for your layout of report. So we are done with it. Now let's go to assumption. If you know that assumption has so much of value, let's see. Each assumption is in each different paragraph. So it is assumed that all figures relating to synergy benefit, beta. See, all these are estimates. Wherever it is estimate, include in your assumptions. Put in your assumptions like benefit, beta, growth rates, multipliers, risk adjusted cost of capital. Probabilities are accurate. So accuracy of estimates. First is that. That is one assumption, that you assume everything is accurate. There is considerable uncertainty surrounding the accuracy of this sensitivity analysis. See, it is in bold. Is probably needed to assess the impact of this uncertainties. This is in your conclusion also, you have to say. It is assumed that BR model provides a reasonable good estimate of the growth rate, and the perpetuity is not an unreasonable assumption when assessing the value of the Fugai. So BR model. BR model for growth. Number 2, assumption. Number 3, it is assumed that the capital structure taken would not change substantially when the new project is taken on. Capital structure. Since the project is significantly smaller than the value of the Fugai itself, this is not an unreasonable assumption. Right? This is not an unreasonable means this is a reasonable assumption to take the capital structure. See, wherever the project is very small compared to that your company, so accepting that project will not have so much of impact on the capital structure of your company. So if you make such assumption also that capital structure will not change, it is reasonable, right? It is accepted to be reasonable. Now coming to this. There may be more outcomes in practice than the ones given, and financial impact of the outcomes may not be known with such certainty. The Black-Scholes option pricing model may provide an alternative and more accurate way of assessing the value of the project. Yes, maybe this might be more helpful. So in outcomes, in practice, you now practical, like in this question, you are just given 2 scenarios. If it is expected that everything will go in the first year, according to first year, then it is a 75% chance of occurrences there. Everything will not go according to plan. 25% chances there. So only these 2 scenarios are there, but in reality, there may be wide variety. So many outcomes might be possible. So all those things we don't know with certainty. So in that condition, Black-Scholes option pricing model may be more better. So here they talked about Black-Scholes option pricing model. This they could have talked about why option was there. You cannot write this as an assumption in everything. Every question you have to see whether option is there or not. In this question, option was there. If option is there, you can talk. It makes sense that you talk about black option pricing model in your assumptions, because even that is one assumption only. So many estimates are used in this black option pricing model. And coming to the last assumption, it is assumed that Fujai can rely on Lumi paying the 50 million at the beginning of the year 2 with certainty. Lumi paying 50 million with certainty. Assumption 50 million. So 50 million is the last assumption. This is also relating to this case study only. See, some assumptions, like if you see the first one and the third one, capital structure and the accuracy of the estimate. These two are general type of assumption. This any question it comes, same assumptions you can give. But other assumptions like BR model, Black-Scholes option pricing model, and this 50 million specific to this case only. You cannot carry forward in another question. But if other question has the same feature like this question, then of course yes, you can talk. If that also has option, then you can talk about this assumption as well. So it is assumed that they can rely with certainty, because they told they're going to pay 50 million in the beginning of this second year. It is assumed that they will pay. So that is one assumption, right? We're not 100% sure that they will actually pay that 50 million or not. Fugai may want to assess the reliability of Lumi company's offer. Yes, you have to see how reliable they offer is, and whether the formal contrast should be drawn up between the two companies. Now coming to concluding comments. Conclusion is also 4 line. Although Nahara would gain more than Avem. Nahara will gain more than Avem. We saw Nahara is getting more than Avem. By now, if you forgot, then we'll go up and show. Again, there's no issue. You can go down. Yes. Nahara is having how much? 27 point, it is in bold. This 27, 276.8, while Avem is already having 174.7. So Nahara is having more Nahara. So Nahara would gain more than Avem from the acquisition, both in percentage terms and in monetary terms, of course. Both companies benefit from the acquisition, but both companies benefited, right? From the acquisition, it is in bold. That means it has to be there in your conclusion. Mark is there. As long as all the parties are satisfied with the values reasonable despite the assumptions highlighted above, it would appear that the accusation should proceed. This is a final conclusion. But before this, before you say accusation should proceed, make sure that all parties are satisfied, value is reasonable despite assumptions highlighted above. Try to bring out assumptions that you have highlighted assumptions above. Bring your assumptions in conclusion. Conclusion means what? You have all what you have discussed, you are bringing at the end and trying to tell the company, look, this are the issues. If you are happy with these issues, then you can go ahead with this project. It is beneficial. This should be your recommendation style. Adopt this way, this tone, this style. Okay, so that's it for this question. Next question is, if I go down, it is 52. And 52, I can see from here, it is an overseas investment issue, right? Where we have net present value. I've told you, net present value and mergers and accusation, you can expect over and over again. 50 marks question. So get ready for this question and come. And we also have option, a real option, I guess, in question 52. I didn't go through this question right in detail, but I will be going through right after this video. And then soon it will be uploaded in my channel. So till then, take care and bye-bye.